Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
There is still data creeping out before the Christmas holiday. Initial jobless claims, Scarlett, coming in at 214,000.
Right, and that is lower than expected. The estimate was for 224,000, and on a 4-week basis, the 4-week moving average, it's about 216,000, which is slightly lower than the previous 4-week period. On a continuing claims basis, we're looking at 1.9 in terms of the claims for overall, and that's compared with 1.90 as the consensus. So these are, it's a high-frequency data point. It's something that we look at more carefully because the jobs numbers have been messed up by the government shutdown. We haven't gotten a lot of clarity on it, and we probably won't get a lot of clarity on those jobs numbers for a couple of months to come, especially if there's another shutdown potentially in January.
Absolutely. The distortion from the jobs, from the shutdown, longest in history. What's interesting, though, is the continuing claims. That is ticking higher, even though we do have the initial claims a little bit softer. But to Scarlett's point, these data points really do matter, given the fact that we are dealing with potentially this distorted data. Right now, financial markets, though, not seeing really any action. Low volume today. It is Christmas, so potentially some individuals not really paying attention to their eco screen. Joining us now, though, to discuss more, Stephanie Roth of Wolfe Research and Bloomberg's Michael Barr. Thank you both for joining us, being in studio. Merry Christmas to both of you. Let's just get your reaction, Stephanie, from the initial claims number.
It's the data looks solid. It's telling us the labor market remains fairly well contained. The layoffs are pretty minimal. There was a bounce back in continuing claims. We have to remember that there was volatility around the Thanksgiving holiday. The trend, it seems like, in continuing claims is it's actually starting to tick down over the past couple of weeks, which is a positive sign. Continuing claims are important to watch to gauge to what extent people who are currently unemployed are finding jobs, the job finding rate.
When you look at this data and compare it to what we saw in the latest jobs report, with the unemployment rate actually ticking higher, though, what do you make of all of it, or is it just too noisy?
I wouldn't read into the unemployment rate ticking up in the most recent print. I think there was an amount of the government shutdown that filtered into the data. BLS said that there was an impact from the government shutdown. They can't necessarily quantify exactly how much. I firmly believe that in the next December print, we will see that employment rate ticking down to potentially 4.4, if not at least 4.5.
Michael, what do you make of this?
Yeah, the timing was different too, right? So the reentries from sort of the college kids coming home had a factor. There's this sort of weirder feel to it that made it very questionable, again, with every other data set we've seen from sort of the shutdown. So again, traders are looking through it, waiting for January to get the December data with the hope it's cleaner. But to what you just said, uncertain if we will get that if there's a shutdown. Lots of questions, not a lot of answers.
We've been there before. So, Michael, given all of this, the fact that the labor data is going to be not corrupted but incomplete for a while, do you then look at the market focusing more on things like the weekly jobless claims, which didn't really get as affected by the government shutdown because these are state-compiled numbers?
Yeah, I think the continuing claims is interesting. You did see some of that picked up in other survey data. And also what I'm looking at a lot is now the beige book. The trending there has been much weaker. You have obviously 3 points, growth, inflation, and the labor market there, where you can kind of extract a trend, and all of it's been sort of negative, including the inflation, which has seemed to be stabilized, moved sort of from the forefront in the summer now to something secondary. And instead now guys are talking about lower sales, lower activity, lower investment. And we saw some of that a little bit in the third quarter GDP, where the investment side was much kind of flatter than you would expect. Now, there was an inventory drag, clearly, and most of the power came from consumption. But my worry is if we move past the AI pulse, the investment CapEx story is much weaker, and some of the PMIs are reflecting that now.
So for those who don't know, the beige book compiles anecdotal evidence of what different Fed regions see taking place in their district. Is that based on activity or is it based on sentiment? Because we know the soft surveys tend to show consumers feeling worried, but in the end, they end up spending anyway.
100%. It's sentiment-based for sure. They obviously are, talking about real activity. And the Fed presidents and some of the governors like to say they talk to contacts in their districts or contacts out there. And this is what they're referring to in a lot of ways. But to your point, the shutdown weighed on sentiment. We obviously have seen consumer confidence hasn't really rebounded yet. Business sentiment has been muddling through. If you look at some of the regional Fed PMIs, it can be quite funny when you look at the comments and how frustrated they are with tariffs and with shutdowns.
And of course, it's not just the jobs data that is, left kind of incomplete, Stephanie. We also see inflation, and the latest inflation report was a good example of that, where we're not getting the full picture. And it looks like we're not going to get the full picture for a while.
No, what we're going to see is the inflation data is likely to tick higher in the next couple months. And up until April, when we get the bounce back in terms of rent inflation, given some assumptions that BLS made. So what we'll probably see is an environment where inflation is ticking higher. And I would actually take the other side on the growth, from a growth perspective. And our expectation is that growth is going to start picking up. It's already seems to be inflecting to some extent. The Q3 GDP data were actually pretty decent. And my expectation is in Q1, the narrative around the economy will be somewhat the opposite of what we've seen in the past couple months, where inflation is a little bit elevated and growth is also picking up.
When it comes to growth, we had the GDP report for the third quarter, rear view mirror, but more than 4%, absolutely stellar. I know the Commerce Secretary thinks that means we're all getting a 4.3% raise.
If it were true.
That would be great. Our management, if you're watching, the Commerce Secretary says that's what it is. But when you see that kind of growth, do you think that's sustainable into 2026?
No, and first of all, 4.3% real GDP growth does not mean nominal wages. That's a different concept. But putting that aside,
take it up with the Commerce Secretary, Stephanie.
Putting that aside, is it sustainable? No, because some of it was linked to net trade, which added 1.6 percentage points. What we're seeing is an economy that's running between around 2.5%. Our expectation is we'll be running around that trajectory for 2026. A 4% pace, absolutely not sustainable, nor is that really the underlying trend anyway.
And it got the attention of the president. He said the financial news today was great. GDP is up more than 4% as opposed to predicted. But the modern market, when you have good news, the market stays even or goes down because Wall Street's heads are wired differently. And he says no one that agrees with him cannot become the Fed chair. What does the Fed do with this kind of mix match you're really describing?
I think they're going to be on hold for a lot of next year, at least until we get the new chair. This was probably Powell's last cut. It's an environment where inflation is ticking higher, like I said. Employment's likely to start improving, so unemployment rate, like we talked about earlier, ticking down. And then the trend in payrolls is likely to be a bit better, in which case it's a tough environment for them to be cutting. So the president may very well not like what he's seeing in the first part of the year because the Fed's unlikely to be able to ease policy much.
Unless the data shows that the labor market is deteriorating so quickly, bad headline numbers leading to a good market outcome. The president has made clear he doesn't like that, but will he just take it in the end?
Yeah, I mean, we'd have to have quite a print in January for the December data to make it just right so that they would move. And to your point, then it's no longer risk management cuts. The market takes it totally different. You're cutting now into weakness, and that's a totally different vibe to talk about what Lisa likes to talk about with the vibes. I know she's not here today. But that changes the whole vibe, right? The rotation, the reacceleration, and I understand, what you're saying, that basically there is this hope that the budget bill and that basically the passing of the uncertainty from the shutdown, from the tariffs, will all have a better sort of pulse into the first half of next year. And that's why we've seen this rotation trade, small caps, cyclicals, even pockets of value have outperformed. But overall, again, the worry is that now the Fed further easing is not based on sort of that good vibe. It's just based on worries and weakness, and then people have to change the sentiment.
Stephanie, what is your biggest concern? What is the most high impact but low probability event that could happen?
In 2026, I would say if we're wrong in the labor market, right, and we see the unemployment rate notably ticking higher, that would, of course, be a sort of negative backdrop. Granted, the Fed in that environment, in theory, would be able to ease unless we get inflation starting to tick higher. Not our view, but if we have an environment where you see both sides of the Fed's mandate come into challenge and the inflation side is starting to really pick up, which is very possible in Q1 in particular because Q1 tends to have seasonal problems, that would be kind of the worst environment.
A question for both of you. Is there potential for recession in 2026?
I don't think the odds are particularly high. I don't think they're particularly higher than the normal recessionary odds, somewhere between 15 and 20%. Of course, the odds are never zero, but I don't think it's abnormally high at this backdrop.
I guess a question I have just, percolating in the back of my mind is, what does it mean if the AI trade is real and we actually see mass layoffs?
That's not necessarily a recessionary backdrop. Of course, it depends on how it all plays out. If we see an environment where the unemployment rate is just steadily moving slightly higher because you have AI, then you have strong growth, productivity, low inflation. That's not necessarily the worst backdrop. If it's mass layoffs, then they come quite quickly. Of course, that's a very different environment. But I think the way it might play out, if it's really AI related, is a more gradual upward pressure on the unemployment rate, which is not recessionary.
Michael?
Yeah, I think you need a shock, something unforeseeable in a lot of ways to get us there, given the momentum is still strong. Again, what I was saying earlier, I'm worried about this CapEx pulse outside of AI. The no hire, no fire seems to be holding. And as we're seeing now, although December looked to have cooled, the consumer has been resilient. Clearly it was in third quarter. We'll see what happens in the fourth. And that's all driving us into the new year with some good momentum. But to the point, there is still a real concern with price levels, not necessarily the acceleration of prices, but the actual levels still weighing on real disposable income and hurting the K economy, creating the K economy and hurting the lower half.
The dollar is projected to be lower in 2026 as well. And of course, we see central banks around the rest of the world, in the UK, Europe, cutting interest rates. Talk a little bit about how the dollar factors into all of this.
Yeah, the dollar is the big debate. And I think it's interesting because you can spin a number of ways. If we do reaccelerate and there are less Fed cuts for good reasons, one would think that just rate differentials alone would support the dollar broadly. Now, of course, there's all these idiosyncratic stories with the euro, with the yen, and even elsewhere on the other G10s that make it hard to really look at the basket and say, okay, we're going to have one move in the basket. But overall, I think it's just going to be more of an alpha from individual crosses. And on the MLive team, we've been having this debate quite vigorously lately.
Stephanie, it's the day before Christmas. It's Christmas Eve. So, of course, there's going to be a lot of people out there doing some last-minute shopping. Consumer spending, retail sales will continue to hold up for December?
Yeah, I think it should be pretty decent. If you look at the real-time data, they look fairly steady. It seems that the consumer just continues to be fairly resilient. And then in 2026, at the beginning of the year, is when you're going to start to get the impact from one big beautiful bill, which then benefits some of the lower-end consumers from no tax on tips, no tax on overtime via tax refunds that come in.
And potentially $2,000 checks. The president's floating tariff dividend checks.
I don't know about that.
Let's see what Congress has to say about it. Stephanie Roth of Wolfe Research and Bloomberg's Michael Barr. Thank you both for coming and joining us in studio, spending your Christmas Eve morning with us.
Stay with us. More Bloomberg surveillance coming up after this.
Dawson of NewEdge Wealth saying equities are undeniably expensive and there are signs of complacency, but this market can chop to new highs. Cameron joins us now. Cameron, give us a sense of what new highs, and Merry Christmas to you, what new highs we can have when it comes to equity markets next year.
Well, good morning and Merry Christmas. I think it's time to dust off the old adage, which is respect the trend, but don't ignore the risks as we go into 2026. Respecting the trend appreciates the fact that we're still very much in an uptrend in this market, and it's also being led by pro-cyclical areas. You mentioned industrial commodities. Earlier, you also have leadership in things like banks as well as transport starting to turn higher. So there's a pro-cyclical message coming out of this market. And you also have a very important uptrend in earnings estimates and GDP estimates. And this has been the key fundamental underpinning as to why we keep being able to press to new highs. As long as you're revising estimates higher, that's usually a good environment for risk taking. So the second half of that is don't ignore the risks. And that's where we look at things like valuations. We look at signs of things like complacency within markets, look at the VIX turning ever lower each and every day. And so it could be in an environment where we're still able to carve out new highs because of those earnings estimates, but there could be some volatility and chop along the way simply because you have a high bar with valuations and a high bar with expectations as well.
But you still think positioning is not yet stretched. What would get us to that point?
Our favorite measure is looking at the Deutsche Bank consolidated equity positioning, and this is really measuring institutional positioning. And what's fascinating there is that we're in the 62nd percentile, which is just about slightly overweight. But if you look at discretionary investors, they're still just neutral. And so we think that there's still room for more people to get dragged into this market. But if we're talking about positioning, we also have to mention households as well. And that's where you cannot make the argument that people are underweight equities. You can look look at the AAII survey that looks at equity positioning, that's at the highest level it's been since peaks like 2018 and 2022. We've talked a lot about how margin loans have grown extraordinarily over the last 6 months at about a 40% clip. So there are certainly signs that households are very fully invested, but some institutional investors have still sat on the sidelines, which just is likely why over the last 6 months or so, every dip has gotten bought so rather quickly.
Yeah, talk a little bit more about that money that's sitting on the sidelines, the dry powder, if you will. We've talked a lot in the past about money market funds and how there's more than $7 trillion of money just sitting there waiting to be deployed. Maybe retail investors are fully invested, but that doesn't take away from the fact that there's always that possibility they could put more into the market. How are you thinking about what it would take to get that money to be put to work?
Yeah, we've never considered the money market funds as exactly fungible funds that could go into equities, meaning that these were savings and cash balances that were typically held in cash savings accounts versus just things that were anxious and waiting to go into equities. So maybe at the margin, as you see those money market funds start to fall, it does incentivize people to look for other investments, but it's not necessarily a direct line straight into the equity market. So certainly, money market rates falling could push investors into looking into other areas instead of just sitting on the sidelines and clipping coupons, but not necessarily $7 trillion of a wall of money that will go into equities.
So the Santa rally that we have right now, how much of it is driven by technical factors like positioning versus true fundamentals, earnings growth, and the earnings outlook for 2026?
Yeah, this time of year, we try not to read too much into the price action given volumes being so very light. And we do know that there tends to be some kind of window dressing and positioning chases into year end. And what's really fascinating is that we saw the rotation in leadership start a little early this year. Typically, we see leadership rotations where you have your classic dogs of the Dow or the last shall be first trade that kicks off in January as people start to rebalance portfolios in a new tax year. But it seemed to start in November this year, where we saw value, for example, outperform growth by 5% since November 1st. So maybe people are trying to get a little bit ahead of that. But at the end of the day, we try not to read too much into very end of year kind of price action, simply because it doesn't reflect anything more than likely just positioning chasing.
Cameron, when it comes to the commodity space, if you look at what happened this year across the entire spectrum, gold, silver, platinum, copper, do you look at that and you think you have to maintain part of this into 2026, or do you think individuals should make sure that commodities are part of their portfolio?
Yeah, we see commodities as a way to have an inflation hedge within portfolios, and they work really well when they work well, and they don't work so well a good portion of the time. So certainly we've been in an environment where that has been a very powerful uptrend for a lot of these commodities. I think the question is, how much can it continue? Jeff DeGraff of Renaissance Macro put out a great piece effectively saying, hey, when you've doubled your return in less than 2 years, the probability of you doing it again is extraordinarily low. So it gets back to this kind of overall notion of respecting uptrends and not ignoring risks. Gold is in a very powerful uptrend. We've been calling it the Chuck Norris of commodities. Nothing seems to be able to keep it down. It doesn't even touch its 50-day moving average. But if you look at longer term charts, it is extraordinarily overbought. So it wouldn't be surprising to see some kind of consolidation. But we do know that there still remains very powerful drivers of, for example, central bank buying of gold, but also appreciate it has become somewhat memeified, meaning that it has become effectively a momentum stock. You're seeing a lot of trading in retail investors as well as investors overseas. So it could get a little bit over its skis and consolidate, but the uptrend is still very much there.
Stay with us. More Bloomberg surveillance coming up after this.
Here's the latest. A federal judge ruled the Trump administration can move forward with a $100,000 fee on new H-1B visa applications. Joining us now is Terry Haines of Pangaea Policy. Terry, I got to ask you, what do you make of this? Because tech CEOs have been going to the White House, and I imagine this has been part of the discussion as well. They want to make sure that they could still get the best and the brightest workers into the United States.
Oh, sure. Merry Christmas, Anne-Marie, and to you and to Scarlett, first and most importantly. They go to the White House and they talk about these things. But, the tech CEOs have a long list, and we all know what they are. And the question is whether or not H-1Bs are at the very top of that list, and the answer is almost certainly they're not, compared to AI and antitrust and competition and a variety of other things. So, yeah, they are very important. But what you played with Lutnick there on the bumper has been very consistently the administration's policy that what it wants to do is not just keep those jobs here, but to train people up in the United States so that there's greater reliance on a United States workforce, and frankly, greater ability of that workforce to deal with the 21st century tech challenges in AI and elsewhere. So, this is not just a matter of the administration flexing its own power. It's got a policy point behind
Terry,
it.
though, the president in 2024 was on the All In podcast, and he said that what he wants to do is that if you graduate from a college, I think you should get automatically, as part of your diploma, a green card to be able to stay in this country. That includes junior colleges, too. What happened to that idea?
I think it probably got, I think they want an idea like that, but I think what ends up happening here is that it becomes less important when against the broader push on H-1Bs.
Terry, is this issue resolved? I mean, I know the U.S. Chamber of Commerce was the one that initiated the lawsuit in October, and we know that following this ruling, the Chamber of Commerce can certainly appeal the ruling. But in their mind, is this something that's pretty much a done deal, and the organizations they represent can kind of move forward?
Oh, I imagine they'll appeal it, Scarlett. There's the thing that markets need to understand is that there are 677 United States district court judges. There's always a district court judge making a ruling on something. There are 2 appeal levels above that. I have every confidence the Chamber of Commerce will continue to appeal. That said, the arguments the Chamber and a lot of other folks make, including the state of California, in trying to overturn this policy are telling all by itself. California, for example, said that two of the reasons that was pushing back against the administration was because of the negative implications it would have for education and healthcare. Now, if you think more broadly about the kind of immigration policies that say Gavin Newsom is interested in, the politicization of that becomes obvious.
Well, speaking of decisions that we're awaiting, of course, the Supreme Court is scheduled at some point in the new year to come out with its ruling on Trump's tariffs, those reciprocal tariffs. What's priced in right now? What is kind of the base case here? It seems as if, given the arguments that have been heard and the responses we've gotten from justices, it is that the Supreme Court will roll with those back.
The base case is that the tariffs go away. I'm very much non-consensus on this, as you might know, for 2 reasons. One is that the court does not dispute the fundamental seriousness of the economic emergency. In other words, the court's not trying to evaluate whether or not there is an economic emergency or not. That actually wasn't even, that wasn't among the questions presented, wasn't discussed, anything. Secondly, there are plenty of other tariff authorities that the president can use should this one be turned back. Thirdly, I think the court probably gives if there's an infirmity in the statute, the court probably gives the Congress an opportunity to correct it. And the Congress, in fact, will have that opportunity in what's now being called Big Beautiful Bill 2.0, reconciliation bill that I think comes up probably in the first quarter of calendar 26. So all this together means that the wishing and hoping that there's going to be some massive tariff rollback and people are going to get a windfall is completely off base.
Terry, when it comes to the GDP data yesterday, a lot of this is AI investment. You had Kevin Hassett speaking to some reporters talking about the boom in AI. Trump in November says he loves AI, he's not worried about it. How do you see this debate playing out in Washington, though, when you have individuals like Steve Bannon talking about constantly that AI might mean layoffs by more Americans?
The administration has made the decision that AI is the tail that wags the dog. I think that AI is the key to everything. Right or wrong, I think that's what they do. They talk. The national security strategy is very plain about that. The so-called Genesis mission or Genesis project that Trump announced is very plain about that. Even the Defense Department's draft report on the Chinese military threat that came out earlier this week is very plain on that. So I think that's beyond debate, frankly, within the administration. And I think that every policy, economic or otherwise, that gets discussed and decided through the AI prism.
I wonder what you make of the Gallup polling we had this week about Trump's approval rating, especially when it comes to the economy. Even among independents, his support has a low of 25%. Americans are just not feeling everything the administration is touting. Do you think potentially going to the midterm elections, they will make the same mistake the Biden administration made?
2 points. One is one is more obvious than the other, I think. One is that the midterms are almost a year away. And in a situation where you've got 10% or more of the House, which is really what's in play here, the tiny House majority, 10% or more of the House seats are not only open, but we're not sure entirely who's going to be running for them. I think it's awfully premature to assume that the Democrats will sweep those. Secondly, I do not think the administration is going to make the same mistake that it did that the Biden administration did on assuming everybody understands what they think and will conform to it. Finally, I think people need to understand that the president is the most popular politician in America. I carry no water for Trump by saying that. I will say that Trump's unfavorable last week was -9 compared to -14 for Republicans, -23 for Democrats overall. And that right track, wrong track since the 20th of January has improved roughly by half. Last week it was 16.5 roughly, and January 20th it was 32. They will attack the affordability problem strongly. They don't care about ideology. They'll attack it any way they can that makes sense, and they've got a lot of time to do it.
Stay with us. More Bloomberg surveillance coming up after this.
Stocks little changed as the Santa Claus rally lifts stocks to new all-time highs. Michael O'Rourke of JonesTrading writing, quote, "We doubt most investors realize how expensive the S&P 500 really is. There's no doubt in our mind it is a bubble. There is strong fundamental business demand, but what matters is the price an investor pays for it." Michael joins us now. Michael, thank you so much for joining us. So you're bursting the bubble a little bit this morning. How should we think about going into next year?
No, I think as we saw that GDP report, the economy is doing very well. Obviously, AI is driving a lot of spending, but we have asset prices are very, very much inflated. And, that quote has to do with the top 20 market cap names in the S&P 500 are trading about 40 times trailing earnings. And that's if you take out Tesla and 28 times forward earnings. So that, those are historically high valuations, historically high multiples. And it's funny, you're just talking about the economy. I would say, we talk about the K-shaped economy where the rich seem to get richer and everyone else is left behind. It's the same thing in the stock market. You have these top 20 names driving the overall market, or obviously even the Mag 8 will drive the overall market, but a lot of stocks are being left behind on a valuation basis. So there are many attractive names out there, but that's not where we are in the index level.
But do you still want to remain that exposure to some of those high flyers, those 20-odd names?
No, I think what we've seen in this market is the crowding into those mega cap names has led to crowding out of many other high-quality blue-chip names. So, for example, in the pharmaceutical sector, with everybody chasing Lilly because of Zepbound, and GLP drugs, a lot of large-cap pharma names have seen their multiples depressed, PE multiples, to single digits, and they're paying somewhere between a 3 to 6-7% dividend yield. So there are attractive areas of this market. I would rotate out of those bigger names and look, down to the lower market caps, but still blue chip names out there in this market.
Down to the lower market caps, would you go so far as to start bidding up the small caps? Every single time they look like they're gaining some momentum, they kind of lose steam, and we start to see everyone rotate back into the big cap names because they can't get away from them.
Well, so the small caps are interesting because they're really, for the most part, an interest rate play or a Fed rate cut play. So most of the momentum we see go into the Russell 2000 or the S&P 600 has to do with, we got a bad piece of economic data, the Fed's going to lower rates, or, inflation's coming in. I don't see, they are more attractively valued. The S&P 600 and the S&P 400 are more attractively valued than the S&P 500 on an index level. But you are, in a lot of cases, just bouncing around with Fed funds expectations. Whereas, like I said, there's a lot of blue chip companies out there, even in the consumer staples space, where you're seeing the multiples come in, and they're names that I think you're getting at a discount that you can put away for a long time because everyone's crowding into the mega caps and chasing this AI trade.
Yeah, you're talking about the bad news is good news dynamic, especially as it plays out for small caps. Michael, what do you worry about the most in 2026? In terms of potential landmines, what is the single biggest risk out there?
I think this AI trade, I do think it's a bubble. I think there's massive speculation in the space. I think you're going to see some of these deals start to unwind or not come to fruition as far as funding rounds and things like that. And I think that's going to spook people. And, while the technology is phenomenal, I think what kind of was lost by a lot of investors is the disruption is pretty easy. And we got our first we saw a taste of that with DeepSeek early at the beginning of this year. But then last month, when Google came out with Gemini 3, people realized, oh, wow, someone could do this better and they could do it with cheaper chips. So I think that's a real risk to the so much money chasing the AI trade start going to this new year.
Michael, when you look at the third quarter GDP report, AI investment and household consumption by obviously the higher income Americans, that's 70% of the growth, those two components together for what we saw in the third quarter of GDP. Obviously, it's a rear view mirror, but that's where the money was spending, AI investment. So if you think that this is overdone, is it not just an issue for the stock market? Is this also a huge issue for the U.S. economy, the real economy?
Well, I would think it is because that's where the growth is, right? Like you said, we talked about this K-shaped economy, and we have people worried about jobs. The labor market obviously has been under pressure since the summer. So if that slows down, it is an issue. I mean, I was looking at the contributions, to technology, investment over the course of this year, and I think it totaled or equaled, the past several years. So it's been strong throughout the year. And the question is, can you continue at the same pace, and can it continue to push this economy forward? Now, that said, the president has announced a lot of initiatives to increase investment in this country. And so, that appears to be coming through. So I do think we have to see that, how it plays out in Q1, Q2 of next year, because right now it doesn't seem like the momentum's stopping. But again, even a slowdown will be, a problem for stocks. Like, what a lot of people forget is back in 2000, when the internet bubble popped, you still had companies like Cisco Systems growing their revenues at 50 and 60%, 9 to 12 months after their stock peaked. So there's still going to be fundamental growth out there. It's just that deceleration is what's going to spook investors.
Well, speaking of spooky investors, there were some concerns about the credit market. You had First Brands, Tricolor earlier this quarter. And of course, the AI bubble fears are starting to show up as well. I look at Oracle bonds and Oracle credit default swaps. Do you see those bubble fears that you mentioned earlier showing up first in credit markets? And if that's the case, are we starting to see it already?
Well, it is interesting because, as you brought up, we've seen that in the auto sector. So you've seen some weakness there. I mean, the tricky part with the credit space, the private credit space for the most part, is you really don't know where the true valuation is. We've seen some private credit funds list, and they wind up listing at, or in private real estate funds listing at 75% of NAV or 25% discount. So there's more underlying weakness out there. But again, it takes time to show up, without real pricing, without transparent pricing and market pricing. It's hard to tell. But again, if you have private credit managers get a little more cautious out there and not writing the loans for these projects or demanding tougher terms, again, that becomes another potential headwind for the market or for the economy.
Right. I think about this sell-side strategists and their forecasts for the market overall, and they are almost uniformly bullish, Michael. About 11% gain for the S&P 500 following 3 straight years of double-digit growth. It feels like everyone's already priced in everything, which then leaves room for external shocks, really damaging sentiment and therefore market pricing.
Yeah, I mean, When you look at the environment we're in, we have equity valuations are extremely rich. Whether you compare it to the Russell 3000 is about 240% of GDP. If you take public and private stocks, I think they're about 325 to 330% of GDP. These are record levels, right? Bloomberg Intelligence came up with a statistic that the largest 200 private companies saw their valuations increase by $2 trillion. And then you have the entire crypto space out there, which is another $3 trillion. So you have a lot of rich asset prices out there, and that will just make you more vulnerable to shocks should a bad piece of news come along.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.